In this week's crypto news update, we'll be diving into four major stories that have taken the industry by storm. First up, the Blockchain Association and the Crypto Freedom Alliance of Texas are suing the SEC over its controversial dealer rule. Next, we'll explore the heated debate surrounding the revival of Satoshi-era Bitcoin covenants through the BIP-420 proposal. Then, we'll take a closer look at the ongoing auction of locked Solana tokens by the bankrupt FTX estate. And finally, we'll examine the record-breaking transaction fees and miner revenue following the debut of Bitcoin runes. The Bitcoin community is buzzing about the potential revival of Satoshi-era covenants through the BIP-420 proposal. Now, I know that sounds like a bunch of technical jargon, but bear with me. Basically, covenants are advanced scripting features that allow for specific conditions on how Bitcoins can be spent in future transactions. They could enable all sorts of cool use cases, like creating secure vaults for reversible transactions or automating recurring payments. The BIP-420 proposal, championed by Taproot Wizards co-founder Udi Wertheimer, aims to bring back the OP-CAT opcode that was originally included in Bitcoin but later disabled by Satoshi himself. Some folks are really excited about the possibilities this could unlock, like smart contracts and on-chain trading directly on the Bitcoin blockchain. But others are worried about the potential risks and complexities it could introduce. Personally, I think it's a fascinating development. I mean, here we are, over a decade after Bitcoin's creation, and we're still discovering new ways to build on top of it. It just goes to show how robust and adaptable the technology really is. Of course, there's still a lot of debate and discussion to be had before anything gets implemented, but I'm excited to see where this goes. Moving on to our next story, the Blockchain Association and the Crypto Freedom Alliance of Texas have filed a lawsuit against the U.S. Securities and Exchange Commission in federal court, challenging the regulator's new rule that expanded the definition of a dealer of securities. The plaintiffs argue that the SEC exceeded its authority by adopting an unclear rule that conflicts with the Securities Exchange Act of 1934. They claim that the rule's amorphous standard could potentially encompass crypto industry participants, particularly those contributing to liquidity pools. The lawsuit seeks a declaration that the rule is arbitrary and capricious and asks a judge to vacate it entirely. Now, I know what you're thinking. Another day, another lawsuit against the SEC. But this case is particularly interesting because it's being filed in Fort Worth, Texas, a venue known for its conservative judges appointed by Republican presidents. It's like the crypto industry is saying, if we can't beat the SEC in the courtroom, we'll just take our fight to a place where the odds are stacked in our favor. I mean, can you blame them? The SEC has been on a warpath against crypto lately, and it seems like they're just making up the rules as they go along. Now, let's talk about the FTX drama. The bankrupt crypto exchange has decided to auction off its remaining locked Solana tokens in hopes of getting a better price than through direct sales. This comes after FTX sold a whopping $2.6 billion worth of discounted SOL tokens to some of the biggest names in the crypto industry last month. Apparently, the demand for these tokens is so high that even the likes of Mike Novogratz and his Galaxy Digital are getting in on the action. But not everyone is happy about how the FTX estate is handling things. Some creditors, like Sunil Kavuri, are accusing the law firm Sullivan and Cromwell of undervaluing the assets and selling them off to their own clients at a discount. It's like they're saying, hey, you're supposed to be working for us, not your buddies over at Galaxy. I mean, I get it. If I were an FTX creditor, I'd be pretty pissed off too. You've got this once mighty exchange that imploded spectacularly, and now you're just trying to get back whatever scraps you can. But to see those scraps being sold off on the cheap to the very same people who might have played a role in the whole debacle, that's got to sting. Finally, let's talk about the absolute insanity that went down on the Bitcoin network last week. As if the halving wasn't enough excitement, the debut of Casey Rodermore's Runes protocol sent transaction fees soaring to unprecedented levels. We're talking an average of $127.97 per transaction on April 20th, which is more than 7 times the average fee rate from the day before. It's like everyone and their mother decided to jump on the runes bandwagon at the exact same time, and the network just couldn't keep up. But you know who's not complaining? Bitcoin miners. Thanks to the surge in transaction fees, they raked in a record-breaking $107.8 million in revenue on that single day alone. That's right, folks. While the rest of us were cursing at our screens and watching our transactions get stuck in limbo, the miners were laughing all the way to the bank. I have to admit, as someone who's been in the crypto space for a while, I've never seen anything quite like this. I mean, we've had our fair share of network congestion and high fees before, but this is on a whole other level. It just goes to show how powerful these new protocols and technologies can be and how quickly they can take off. But it also raises some important questions about the long-term sustainability and scalability of the Bitcoin network. If a single protocol can cause this much chaos and disruption, what happens when we have even more complex and demanding applications running on top of it? I don't have the answers, but I think it's something we need to be thinking about as an industry. And that's a wrap for this week's Crypto News Roundup. We covered some pretty heavy topics, from legal battles and bankruptcy proceedings to technical innovations and network disruptions. But through it all, one thing remains clear. The world of cryptocurrency never stays still for long. There's always something new and exciting happening, whether it's a groundbreaking development or a complete and utter mess. So, what can we take away from all this? Well, for starters, I think it's important to remember that investing in crypto is still a highly speculative and risky endeavor. None of what I've said today should be taken as investment advice. As always, you should do your own research and make your own decisions based on your individual circumstances and risk tolerance. But beyond that, I think these stories underscore the importance of staying informed and engaged with the crypto community. Things move fast in this space, and if you're not paying attention, you might miss out on some really cool opportunities or get caught up in some really nasty surprises. So, keep your eyes peeled, your ears to the ground, and your wits about you. The future of crypto is still unfolding, and we're all along for the ride. Until next time, happy trading, and remember, always do your own research.